All right, well, more and more investors, though, are no longer expecting the Fed to cut rates in June. This comes after a string of stronger than expected econ data prints. Now, traders are now pricing in a 79% chance that the Fed is going to hold rates steady in June. That's according to the latest data from the CME Fed Watch tool. Our next guest, though, saying that a June cut is actually still on the table. We want to bring in Simona Mocuta. She is State Street Global Advisors Chief Economist. Simona, it's great to see you again. So talk to us just about the market doesn't think a June cut is likely, but you do. Why?
I think it's possible. I have to say it's very hard being a dove nowadays, but the reality of the situation is a lot can happen in the next 2 months, right? We sit here in the middle of April. The June meeting is in the middle of June. We have 2 more employment, 2 more inflation reports from here till then. So I think what I'm trying to say here is let's not entirely take June out of the range of possibilities. I think there are a lot of reasons that still argue in favor of an early start to the cutting cycle, despite the string of inflation data that we've seen. Some of these really are the same arguments we've made for a very long time. Fed funds relative to inflation, and despite the numbers we've had, core PC inflation is still, inching lower and approaching 2.6, 2.5% by the time the Fed will meet in June. In our expectation, there is a long lag with which monetary policy operates. There are some timing issues around the U.S. election, so controlling the narrative, controlling the process, and deciding when to go, and perhaps creating a little space around what's coming down the line may be the better option for the Fed after all. Obviously, everything will hinge on how the data plays out over the next 2 months, but it's very hard and very rare to have half a year of upside inflation surprises. I don't think we are in the same place today from any angle, supply chain demand imbalances, supply demand imbalances, as we were in the early recovery period after COVID. So it's a different kind of moment in time.
Simona, this is so fun to get to talk to someone who has a different view when we have the UBSs saying we could even have a hike this year. So I very much appreciate you coming on and having this different view. I'm curious about something you just said about the election and how that could impact timing. Can you extrapolate that out for me and what your thinking is on that?
So it's never, in an ideal situation, I think the Fed and any central bank would try to create a little bit of space around big political events, just so that no wrong conclusions are being drawn or equal signs being put between an action that they may take based on macro data and the interpretation of that action in the context of the political event, right? So I think that's partly actually why the market has faded so many of the cuts, because there is an assumption there that the Fed cannot cut in September or cannot cut right after the election. I think the Fed can, and if the data compels them to will do so, even if they don't make aggressive moves or significant moves until the fall. But it's something that in ideal situation you probably want to avoid.
Simona, what would the fallout be if the Fed does not cut by July? We talked about the fact, and you sent over in your notes, and you mentioned briefly there, just that could be a potential risk, a potential mistake. Why, and what does that fallout look like?
I think it just it inflicts unnecessary pain. I think I've heard you talk in an earlier segment about the consumer dynamics. I think it would be a mistake to equate the resilience of the economy so far with the idea that, borrowing costs are not high. They are high. And for an increasing number of consumers, especially those that do need credit, it's getting harder and harder and quite expensive to access it. So why do that if you don't need to? At the end of the day, we heard from the Fed earlier that disinflation is reason enough for rate cuts, and you don't need to be at your target in order to begin the cutting cycle, because we know it's a long process for these rate cuts to work through the economy. So the idea of the long legs, the idea of controlling the narrative, I think it's a mistake for the Fed to tie its hands so tightly to any monthly data point, right, and become, tied by, a 0.358 or a 0.359. That is how the market may operate, and even that is not always wise, but that's not how monetary policy should operate. And I think the focus should be much more on the longer term trend, which remains one of disinflation.
Well, I'm curious then, while it may be a mistake and while you know that there are lags to the impact of monetary policy, the Fed has made it so clear over and over again, we are data dependent and the data keeps being hot. So what would be the single biggest catalyst to make them change their minds from that guiding light of the data at this point?
Yeah, I think the one thing we had heard from Chair Powell time and again was signs of weakness in the labor market. Now, I think there's two sides to that, and the interpretation of these words is important. So, what is a sign of weakness? Frankly, do we need a sign of weakness in the form of, a sudden decline in employment growth, or should we focus on the area that really we should be focusing on, which is we are hiring a lot of people, but wage inflation moderates, right? I mean, actually, that is what you want to watch, and I think. It may not be the catalyst for an immediate cut, but I think it is the catalyst and the core argument for a cutting cycle to begin. This idea that you're normalizing supply and demand, even in the place in the economy where you had the most tightness or apparent tightness, which was the labor market. Remember all the anxiety around core services inflation, and it's true that we had this insurance and medical cost, forcing that component higher. But the rationale, the fear was that would be because wage inflation in that space is very high. But you look at wage inflation in those sectors where we are hiring a lot of people, education and healthcare, leisure and hospitality, and you actually see wage inflation moderate substantially. So the sort of stickiness we see right now, it's not driven by the stickiness that the Fed at its heart truly fears, which is a wage price type of spiral.
All right, Simona, we're going to have to leave it there, but thank you so much for joining us this morning. Really great insights. That was Simona Mocuta, State Street Global Advisors Chief Economist.